Hey investor friends, I'm Michelle Markey, and today I'm generally going to explain what growth stocks and value stocks are, their historical performances, and some examples in the stock market. And as with many popular rivalries like between Coke and Pepsi, Starbucks and Dunkin', Kansas City versus Memphis style barbecue, and New York City and LA, people seem to think that there's an adversarial relationship between growth and value stocks, and I'll explain why some of that isn't really a big deal. And sometimes people also tend to think of investors as growth or value-oriented investors, such as Warren Buffett being more of a value investor, and maybe Chamath Palihapitiya could be more of a growth-oriented investor since he's been promoting a lot of SPAC IPOs, which are expected to be fast growers. So even though some people and stocks get labeled with either growth and value, it doesn't mean that they necessarily have to be confined to these labels. And the good news is that you can invest in any kind of stock regardless of whether they might be considered value or growth stocks. As long as you do your homework, you're bound to be rewarded as an investor. And if you feel my content delivers value to you, I'd love if you could please like and subscribe to my video and YouTube channel, because I'd love if the YouTube algorithm could treat my content like a growth stock and have it be promoted to others. So I greatly appreciate your watching. To illustrate an example of what people's expectations tend to be with value and growth stocks, I'll use Olympic track and field events as an analogy. And with something like the field event of shot put, people might expect solid performance, and if we win gold, then great, and when we do win gold, then that's tremendous value. And compare this to the track relay event, where people are really expecting the fast runners to deliver the gold because historically they have, and this event tends to have more viewers than maybe the shot put event does. So the relay team better deliver the gold, or else that will disappoint a lot of the American viewers who want the team to really win. And so we can see that both events have the ability to deliver a gold medal, and so the same thing can happen with growth and value stocks. Just because some may be a little bit more exciting than others doesn't mean that they can't have the similar golden results. Much like fast track runners, a growth stock is a stock of a publicly traded company that's expected to generate positive cash flows and whose revenues and earnings are expected to increase at a faster rate than the average companies in the same industry. And generally, they're expected to deliver 15% or better return on equity, and they might give lesser dividends because they're reinvesting their cash flows into growing the company. Value stocks have more of a storied history in that they come from the concept of value investing that was developed by Columbia Business School professors Benjamin Graham and David Dodd in the 1920s, and then they came out with the book Security Analysis in 1934 to instruct people on how to identify and how to buy undervalued securities that were trading at a discount to their true intrinsic value. And so if you did this and bought value stocks, eventually the market would realize the true value of the price, so the intrinsic value and then the market value or price would converge someday. And to explain why a lot of people think of Warren Buffett as a value investor, I'll share a brief timeline showing the evolution of Warren Buffett's investing style. And we can see he started out early, learning from his stockbroker father Howard and buying his first stock at the age of 11. And then when he was age 19, he just happened to buy the 1949 Intelligent Investor that Benjamin Graham wrote. And then he was taken by this book and really into it. And then he went to Columbia Business School in 1951 and took Ben Graham's course and was really influenced by Ben Graham's way of deep value investing in cigar butt companies, where you expected to just get one last puff out of these companies, maybe in terms of their earnings, and then that was kind of it, and then you dump them and bought other cigar butt companies. So arguably he probably invested like this for the next 10 years, from 1949 to 1959, by the time he met Charlie Munger and had dinner with him in Omaha, Nebraska. And fun fact, they were both from Omaha, Nebraska. And unlike Ben Graham, Charlie Munger emphasized focusing on quality companies at a fair price instead. So with this kind of change in influence, we can see that over the last 60 years that Warren Buffett has evolved his way of investing. And actually, even though he started out more as a traditional value investor like Ben Graham, he actually evolved to invest more in quality companies, which is maybe neither value nor growth per se. And according to to one study, Warren Buffett has actually invested through Berkshire Hathaway in more large cap growth companies than value stocks. So it just goes to show that even though people think Warren Buffett is a value investor, he's actually just an all-purpose investor, investing in whatever good companies come around. There could also be a lot of overlap between growth and value stocks. Like when Warren Buffett bought Apple back in 2016, you could argue Apple could be both a growth and or value stock. So depending, the boundaries aren't always super crystal clear. And to share what Charlie Munger really thinks about all this, I'll direct quote him, in which he said, "All intelligent investing is value investing, acquiring more than you are paying for, and you must value the business in order to value the stock." So to put this in practical terms, I think a lot of us enjoy getting a good deal, like when we see 50% off sales. And so let's say we might be hankering for a new TV, but instead of buying it at full retail price of $548, we wait until there's a Black Friday sale where it's almost 50% off, and we save $270 to buy it at $278 on Black Friday. While you could arguably apply value investing principles to buying growth and or value stocks, let me take you through how the financial mainstream tends to compare these two. And growth stocks tend to have above average gains in earnings, and they're expected to continue high profit growth, and they're more expensive than the broader market, and they have high earnings growth. They're more volatile than the broader market. PE ratios can go beyond 30 or even 100. They have the potential for big booms and busts. They tend to be faster growing, innovative or disruptive companies like tech, and they perform better in bull markets. Compare this to value stocks that tend to be out of favor but have good fundamentals, and they're lower priced than the broader market, and they're priced below similar companies, and they expect the intrinsic value to be realized, and they may be suitable to longer term investors, and their PE ratios are often below 15, but there's the potential for value traps, and they tend to be slower growing and more established companies like banks, and they perform better in bear markets. So sometimes maybe people think of companies like Tesla as a growth stock or Berkshire Hathaway as a value stock. And so to summarize, growth stocks tend to have higher earnings growth, while value stocks tend to be undervalued in the market. It's conventional wisdom that value stocks outperform growth stocks over the long run. And as this Forbes article points out, since 1926, value stocks have returned 1.3 million% compared to growth stocks returning 600,000%. So that might make you think that value stocks are the better way to go and invest, but not necessarily, because growth stocks have been doing much better than value stocks over the last decade. And also, depending on when you're investing and for how long you're investing, so you're going to have your own investing time horizon. This may be different than some of the historical cycles when maybe value did well or growth did well, respectively. So you can't really go by maybe investing in large cap growth or value or small cap growth or value, because their cycles could be very different than your individual investing time horizon. Looking at various articles online, it's sort of funny how sometimes a couple of the articles don't arrive at the same conclusion using similar data of the Russell 1000, which is the largest 1,000 companies by market cap in the US. And so if we look at this Seeking Alpha article, they took the Russell 1000 Growth Index and the Russell 1000 Value Index, and from 1983 through 2019, they conclude that value outperforms growth over the long term. But then this other article shows a similar graph of the Russell 1000 companies from 1980 through 2018, and they conclude that growth trumps value. So I kind of want to believe that the Seeking Alpha one might be a little bit more believable, because they actually show the excess returns of value stocks compared to growth stocks. But in any event, and looking over the last decade or so since the great financial crisis, there's no dispute in this Vanguard article showing that the Russell 1000 Growth has delivered 17% average returns compared to the Russell 1000 Value Index, delivering around 10% returns. And then this is also backed by a Franklin Templeton example showing also how since 2007 that growth has outperformed value. And then looking at another article, they took the Wilshire Growth and Value and maybe the Wilshire here is based on all of the companies in the stock market, so around 3,500 of them, and they judge that in 34 out of the last 40 years that growth outperformed value. So who knows who is really correct, but you can see that none of this is super clear, and maybe it doesn't really matter that much which kind of stock group has performed better than the other. What's more important is for all of us to research companies that we're interested in and to only invest in the kinds of companies that we can believe in. And using a security example that people could invest in if they want to based on the growth and value criteria, we can look at this Invesco Pure Growth and also Invesco Pure Value ETF. And the growth one is known as the ticker symbol RPG, and the value one is known as the ticker symbol RPV. And we can see in this chart that the growth one has been outperforming the value one significantly over the last 10 years. And I think this ETF has been around since 2006. So overall, the RPG ETF is definitely beating the RPV ETF. But interestingly, if you had invested in the low of March 2020, your RPV ETF would have outperformed the RPG ETF just a little bit better. But overall, you would have had to invest a while ago to reap most of the gains with the RPG ETF. And if you're curious like me and want to know what factors they use to decide which stocks would qualify as growth or value stocks, I looked at Invesco's criteria, and for a growth score, they decided on these factors of sales growth, ratio of earnings change to price, and momentum, which was the 12-month % change in price. And compare this to the value score, where they use ratios to price of book value, earnings, and sales. And then I was curious on what constitutes these ETFs. And then for the RPG ETF, we can see that the stocks that are in this include Monolithic Power Systems, NVIDIA, SVB Financial, Etsy, Tesla, Fortinet, Align Technology, PayPal, ServiceNow, and Generac Holdings. And a lot of these are in the IT sector, which is not surprising. And then for RPV, many of these are in the financial sector, and they include the likes of Berkshire Hathaway, Lincoln National, Ford Motor, Prudential Financial, MetLife, Lumen Technologies, Hartford, CVS, Valero, and Hewlett Packard, or also known as HP. And then I wanted to look at how these ETFs have performed. So over the last 10 years, the total net return of the RPG ETF has been around 18%, but interestingly, that's a little bit less of a performance compared to the S&P 500 growth benchmark. And then with the RPV, that returned 13.5%, and that actually did better than the S&P 500 value benchmark. And then for some fundamentals, with RPG, their projected PE is supposed to be 36.19, which is pretty high, and I'm surprised that they don't have a trailing PE available. And then if we look at RPV's fundamentals, they actually have a surprisingly high trailing PE of 34.52, and then their projected PE is to be 10.72. So they're kind of projecting that the value ETF is going to go down in its PE, which kind of signals to me that they're expecting some of the stock prices that are in this ETF to maybe go down. Meanwhile, the growth ETF is supposed to keep high PE stocks. So let's see what shakes out in the next several years with these ETFs. So I hope these examples give you some interesting food for thought. And just remember that past performance is not a guarantee of future performance. And I like how this NerdWallet article provided a neat table summarizing the differences between value and growth stocks. And in general, we can think of value stocks as being undervalued, so maybe their price is lower, while growth stocks tend to be maybe overvalued or have a higher price. And value stocks tend to have a lower PE, while growth stocks tend to have a higher PE. And it doesn't have to be one or the other, like the article said. You can choose to invest in whatever makes sense to you, regardless of what the industry might classify any given stock or ETF as. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.